and you can have a niche where you establish minimum efficient scale. There are some niches, some industries that can only profitably support one or two players. If another player comes in, spends the money to get in, returns come down so that nobody makes any money, so that new entrant never comes in the market. That can be, the businesses often can't grow very well because they're kind of trapped there, but they can be enormously profitable. So what about management? You notice I haven't said a word about management yet. There's a great quote from Warren Buffett that good jockeys will do well on good horses, but not on broken down nags. So this is a professional jockey on a goat. He is a very good manager. Sadly, he is on a bad vehicle called a goat. So if you enter this in a race, he is probably going to lose. By contrast, if you got me, and I don't even know how to ride a horse, as long as I don't fall off, I probably beat the goat. Because the horse is better suited for winning races than the goat. You're not going to get much milk out of it. The goat is better for that. But it's very well suited for winning races. So the key here is that you want to get a good horse. You want to look for good horses. It's not that the jockey is irrelevant. It's that even the best jockey, if he's on a goat, isn't going to make you a lot of money or win many races. Managers matter in the context of the moat. And the way to think about this is very simple. The required level of managerial skill is inversely related to the quality of the business. The worse the business, the better the manager. The better the business, as long as management isn't that stupid, you'll do fine. If it's a really bad business, you better have an awesome manager. This is Ryanair. O'Leary is an absolute genius. He's a jerk, and customers hate flying Ryanair, but he has created an amazing, amazing business. Ryanair is scale advantages to die for. By contrast, if you have a great business, genius is not needed. You saw where this was going, I know. He's actually, what that actually means is, here's what's happened to Microsoft's moat while I've been in charge. It's an easy target here at Google, but it's true. I mean, Steve Ballmer essentially spent 12 years setting money on fire at Microsoft, as far as I can tell.
What do you think about Twitter?
Well, Twitter, never followed it much. And also that wasn't, no pun intended. The question was, what about Twitter? I haven't figured out what the monetization model is. I haven't figured out how they make money. I mean, they may have some secret theory. I just don't know what it is. But I haven't spent much time on it. Although I think it was founded by a guy named Dorsey, wasn't it? Anyway, I probably should look at it. So the key here is that moats can buffer management mistakes. Microsoft minted money despite Steve Ballmer. Despite them shoveling dirt in the moat every day, the core Office, the core Windows franchises were strong enough that the business overall maintained pretty high returns on capital. New Coke didn't kill Coca-Cola because the business was robust enough, the brand is strong enough. Moody's put profits before integrity, actively screwed investors, and still cranked out a 40% operating margin. That's a pretty good moat. But even a genius like David Neeleman couldn't change the fact that JetBlue is an airline, which is the worst industry known to mankind. I mean, he's an amazing manager. If you've ever met him, read any of his books, seen him speak, he's incredible, he's inspirational. JetBlue was like 30-odd times earnings when it went public because it had leather seats and TV. I mean, an airline will never have lower costs than the day it opens for business. Why? Planes don't get newer, they get older. Employees don't get less seniority, they get more. So the planes cost more to run, the employees want more money. So the cost structure is inevitably bound to decline. Again, great jockey on a goat. Good managers are constantly looking for ways to widen a company's moat. Think about Amazon's focus on the customer experience. It's not so much about scale, it's about the customer experience. Here's a great, let me try this here. I've tried this at other talks around the world. How many of you have bought something off Amazon without checking the price elsewhere? Okay, that's like 2/3, 3/4 of the hands. Isn't that an amazing statistic right there? I mean, how hard is it to click to another website? What's the caloric cost of moving your mouse? It's not high, right? But I've talked to probably 45 CFA societies around the world. I get that's about the same number of hands that go up. except in Germany. The Germans didn't seem to, maybe Amazon hasn't done as well. Maybe Amazon has not been as, there's Zalando, there's a lot of other e-retailers there, but in the US, this is the response you get. And a lot of this is the customer experience, right? Trust matters more online than offline. And I give Amazon enormous credit for figuring this out early. That offline, in a regular physical store, I give you money, you give me a good, and we're finished. There's no trust involved. Online, I have to trust you send me what I ordered. I have to trust you don't steal my credit card number. I have to trust it arrives when you say it will. I have to trust you'll take it back if you say you will. There's a lot of trust involved. And that enabled the ability to build a moat, build a brand in retailing, which is a really tough industry to do that in. Think about Costco's focus on using scale to lower costs. Costco gets bigger, cost savings go right back to the customer. That brings in more customers, which allows more cost savings that go right back to the customer. That's what drives their business. That's all they think about every day.